We're 5 days away from the Trump inauguration, and business leaders are planning for a very different environment. A new survey from global consulting firm AlixPartners says CEOs are predicting major business shifts in 2025, including adjustments from tariffs, U.S.-China relations, and the growing cyber and data privacy threats. Well, joining us now is Simon Freakley. He is executive chairman at AlixPartners, a global consulting firm focused on turnarounds and disruptions, and it's great to have you here on set, so welcome.
Thank you, Morgan. Thank you, John. Thanks for having me.
So this is exactly where I want to start, because you did just put out this survey, and basically a lot of uncertainty, a lot of volatility, and yet it also seems like a lot of CEO confidence in the face of it. Why?
So look, the survey data was gathered before we knew the result of the presidential election. The biggest concerns on people's mind were taxation and regulation. We ran a mini survey of 500 executives after we knew the result. Taxation and regulation fell away as a concern. Tariffs are now the biggest question in the US. But the biggest takeaway from our sixth survey, 3,200 executives in the major economies of the world, is they're getting more confident in their ability to capitalize on the opportunities coming out of these multiple disruptions rather than feeling overwhelmed by them, which they were a few years ago.
And I do want to get into some of those disruptions and what that looks like and what that means, especially, you know, in the face of AI and these new technologies and innovations. But first, just one more question, because tariffs are very much, and trade policy is very much in focus for C-suite, for the markets, and investors as well. I was just at the ICR conference earlier this week, and one of the takeaways for me was that some of the executives of consumer-facing companies there were making the case that they've already been moving some of their supply chain away from China, given what we've seen with tariffs, given what we've seen with pandemic over the last couple of years. So maybe it's a different dynamic and maybe perhaps not so disruptive depending on your company and your industry this time around.
Morgan, I think that's absolutely right. I think coming out of the pandemic, people realized they needed supply chain strategies that were just in case, not just in time. So I think they developed second and third options in supply chain. But I think particularly with tariffs in mind, coming into a Trump presidency, people anticipated this could be a problem. They started to stockpile certain things. They started to find different routes to get critical supplies. So I think people are somewhat ahead of the game. But of course, people just don't know how big a disruption this is going to be. They don't know what the impact on their business is going to be. And they're trying every strategy they can to mitigate it once they know exactly what it is.
You're talking to global CEOs.
Yes.
Are you seeing much difference depending on where that CEO is based, where that CEO's largest customer base is?
Yeah, absolutely, John. So what we're seeing in the US, that over six sets of disruption surveys, the disruption in the US seen through the eyes of US CEOs is seen to be about the same as it has been for the last couple of years. In Europe, in EMEA, CEOs are feeling much more disrupted. Why is that? Well, obviously, Germany and France, their governments lost no confidence vote. A new government in the UK displacing 14 years of conservative rule. Immediate impact of the Russian invasion of Ukraine and the long-lasting impact on supply chains there. So the anxiety, the disruption in Europe has gone up. In the US, it's stayed the same. Interestingly, in Asia, it's gone down. And so it's not a one-size-fits-all.
Is that unusual to see the level of difference between, say, the U.S. and Europe that you're seeing now?
It is a little unusual, but I think seen through a geopolitical lens, maybe it's not counterintuitive. I think there's been so much political dislocation in Europe. That anxiety is playing out in the corporate sector. There hasn't been the same growth, of course, in Europe over the last few years as there has been in the U.S., so there isn't quite the same confidence or the same momentum. But it was surprising to us that it was so pronounced.
AI, how is that factoring in now?
Well, so interesting, Morgan. Of course, one of the reasons that CEOs, global CEOs, American CEOs also are feeling more confident is that they're seeing AI and automation and robotics as being a real opportunity, not just for cost cutting. You know, we're all familiar with the stories of how to cut down the cost of call centers and how to get administrative functions trimmed down with AI. They're now really leaning into AI to drive revenue growth. They're leaning into robotics and automation to augment productivity in a way they can't solve the problem through human capital. So the marrying of automation and robotics with human capital to get greater productivity, the use of AI to drive revenue, not just mitigate cost, and making CEOs feel more optimistic.